Last episode, I resolved to make amends for my undertrading sins. Fortunately, this was a lot easier to fix than my overtrading problem. I spent most of my life overtrading, and it required me to spend many long years mastering the zen of diamond hands to get that overtrading problem under control. So when I realized last month that I now had the opposite problem, and was undertrading, I was very worried. Would I have to begin that journey all over again? Would I ever achieve the enlightenment of true balance? Well, I don't know about balance, but it turns out that it was super easy to turn the trading back on. Like, so easy. All I needed to do was think, maybe I could trade more. And like 15 trades instantly shot out of my body like I'd turned into a fucking Gundam. But before we get into what the trades were, we've got to set the scene a little bit. After a roaring 2023, we've had a bit of a rocky start to the year, as we've been largely trading sideways for the first 3 months despite a big surge in the overall market, leading to a major decline in our outperformance. We got a bit beat up during reporting season, just barely coming out with a profit, but this episode is the first episode of the series where we've had a portfolio decline. We're not here to lose money. What's more, I have a YouTube channel, so that shit's embarrassing. Essentially, soon after the last episode shipped, it was the portfolio's darkest hour. BFL retraced. Capril retraced. CRN fucking cratered, and we didn't have any green stepping up to take their place. What's more, I had an overwhelming sense of FOMO about Big River Industries. I'd sold out completely from BRI just before the half-year report dropped, because I was expecting a bad one. And this meant that I escaped the 15% decline that the report caused when it dropped. But that didn't change a whole lot about the fundamentals of the business. They are printing cash, and with rate cuts on the horizon, 2025 could be a new dawn for the construction industry. You can't enter a trade like that at the last minute, because everybody can see it coming. There is a good chance that BRI is going to do nothing but trade sideways for the second half of the year, and if so, so be it. But there's also a decent chance that it will post a substantial gain as people jockey for position ahead of 2025, and I'm not willing to miss out on that. There's 1,000 other investors out there thinking exactly what I'm thinking about the construction rebound, and the only way I'm going to get their money is if I'm the guy who gets in first. But since all my picks have only gone down since the February episode, I didn't have any clear source of capital to buy it with. There were no exits I could feel good about. I just had to pick the least bad exit. I decided that the least bad exits were Hum and ORA. Hum was still up a tidy 15% from my entry, and ORA was up 4% plus a 2% dividend. All in all, not an abysmal performance, but both of them were a far cry from their recent highs, and it left a bitter taste in my mouth. I gritted my teeth and prepared to take them out behind the shed. My reasoning for selling Hum was that despite its solid underlying financials, it had always been a bit of a problem child. The management were kind of sketchy, not least of which because of the reporting practices I discussed last episode. Walking away with a 15% gain from a problem stock is a really good outcome that I shouldn't take for granted. And the reason I decided to cut ORA loose is because the US manufacturing indicators for the first 2 months of this year, those indicators I ignored leading up to the report, resulting in me losing a bunch of money. Well, this time, I've learned my lesson. I've been paying close attention to these indicators, and they've been sending mixed signals, but largely negative for the current half. I do think ORA is trading cheap, and I hate to sell it so close to the lows, but there's no reason to hold it if I can just come back in August and get it even cheaper. The macroeconomic winds are not blowing in their favor, and while I believe that they'll be a long-term performer, their near-term prospects just don't justify the opportunity cost of holding, especially when there's amazing opportunities elsewhere. So there you have it. Bam, Hum is out. Bam, ORA is out. And with the proceeds, I mostly just piled back into BRI and hard, making it well and truly my second largest holding, with an average acquisition price of $1.77. Although now with Hum out of the portfolio, I did pick up a very small amount of shares in a new ticker I've been eyeing for a while, called MME, or Money Me. They're essentially just doing consumer finance, but with a very digital and customer-oriented offering. Nothing groundbreaking, but I like their financials and I like their business model. And perhaps most importantly, they aren't being obviously sketchy. This stock is volatile as all hell and is definitely a more speculative position, so I'm probably going to keep my holdings small unless the share price posts some major declines, in which case I reserve the right to double down. Or, obviously, I also might increase my holdings if they post some good results. But that is not the end of the story, nor the end of the trades, oh no. If you thought it was our darkest hour before, things got even darker. Right after this major rebalancing, CAA, my absolute favorite stock in the whole portfolio, just kept on sliding, and sliding, until, for a brief moment, it poked its head below $9. I had been resisting buying more up until this point, because it is and always has been the largest position in my portfolio by far, making up the vast majority of my allocation and the vast majority of my gains. But seeing it drop below $9 was just so absurd to me. And rather than disappointment or excitement, I felt something like righteous fury. The earnings yield on this stock is like 20%. The net tangible asset backing per share is 10% more than the share price. It has some of the best fundamentals I've ever seen, and somebody dares to sell under $9? I felt almost like I had to punish them by buying their shares. I know how weird that sounds, but like, somebody dared to put red on my screen, and it kind of felt like taking their shares was the only punishment available to me that I could dish out. So I did. I took their shares. And literally hours later, CAA had shot up 6%. And that 6% was in my pocket, not theirs. So in a way, my punishment was successful. I still really don't know how to feel about all this, to be honest. But whatever. Now I guess you're wondering, where did I get the money from? Just like when I was trying to buy BRI, I had no obviously overbought stocks to liquidate. The pickings for potential sales were even slimmer than last time, because I'd just cut the fat out of the portfolio days earlier. There was nowhere that I could pull any extra capital from. Or was there? Literally as I was staring at my screen grappling with this conundrum, Tamerwood announced an interim dividend of 11 cents. I did not really give a shit about this, because it was obvious to everyone with a brain that they had resumed making money, and when companies resume making money, they generally resume paying their dividends. But somebody gave a shit. And not only that, they gave so much of a shit that the shares jumped 12%. This was exactly what I needed. I actually already had a small sell order posted at $2.50 that had been there for weeks, which got immediately blown out. And over the next few days, I fired off multiple small sell orders the whole way up, so as not to scare off the buyers by dumping a load on market all at once. Including that initial order, I ended up getting an average price of $2.63. I know it looks like $2.63 is a long way from the top, but the spreads on this stock are like 20 cents wide, so even getting that price was a lot of work and timing. Anyway, this freed up another $22,000, which I put half into BRI and half into CAA. Or at least, I tried to put half of it into CAA. The way I see it, when you're trying to pick the bottom of a price movement, placing an order and getting only a partial fill is like the ultimate power move. You didn't just buy near the bottom. You didn't even just buy the exact price of the bottom. You became the wall that the price rebounded off. Once the traders realized the bottom was in, the price flew 6.6% in the same day, but eventually it calmed down and settled back into the $9.30 range, still significantly up from my top up, but a long way below the $10.20 it was riding at last episode. As such, this is the first month since I started the series where the portfolio did not increase in value, and while it does suck to post a decline, I'm not too torn up about it. Even with the recent decline and the massive surge in VAS, we are still doubling the market's year-to-date performance, which means I'm tripling the average hedge fund. Fluctuations like this are to be expected, and for people who take a long-term view of their stocks, it pays to be dispassionate about these sorts of fluctuations. With any luck, CAA will return to its highs over the next few months, and it is basically half of my portfolio at this point, so whatever CAA does, the portfolio does also. Thanks for watching, and I will see you in the next video.